Welcome to Breaking News to Trading Moves.
Glad to be here.
And we are looking directly at you, the listener, right off the bat today.
Setting this premise right away.
Exactly. We are looking strictly at a recent headline regarding Marvell Technology.
Just the headline and the facts.
Right. We are going to analyze the direct numbers, and then we are laying out the specific winners and losers across the market.
Purely based on the reported data.
No exaggerating. We are not implying this single headline creates some massive macroeconomic shockwave.
No, we stick purely to the stated facts and the list of affected companies.
So, getting right into the main event, Marvell Technology recently saw its stock surge following a bullish, multi-year AI chip outlook.
Which is an incredibly specific projection from the company.
It really is. They gave us a very clear window into actual hardware demand.
Yeah, the exact numbers driving this optimism are, well, they are highly material for the broader sector.
Let's get those numbers out there.
Right. So Marvell stated that their fiscal 2028 revenue could reach around $15 billion.
$15 billion.
Yes. And to put that in context, that figure is well above current market consensus.
Wow.
Furthermore, they lifted their fiscal 2027 growth outlook to more than 30%.
Let's take our time here and really break down what a multi-year fiscal outlook like that actually means for market confidence.
We should, because a company does not simply, guess that they will hit $15 billion in revenue a few years out.
No, especially not in the semiconductor sector.
Right. A projection like that requires extreme confidence in your order book.
Because lead times for specialized hardware are incredibly long.
Exactly.
Yeah.
You are dealing with advanced packaging constraints, wafer reservations at fabrication plants.
Securing rare raw material.
All of it. The supply chain realities dictate that you cannot pull these numbers out of thin air.
So a multi-year fiscal outlook of this magnitude, it means Marvell is looking at firm, long-term commitments.
Firm commitments from their major clients.
Mm.
You do not just order a custom chip and have it delivered the next day.
Right.
These are multi-year engineering and production cycles.
So when Marvell says they see greater than 30% growth for fiscal 2027, they are looking at locked-in capacity expansions.
From the largest technology companies in the world, they know exactly what those clients are building.
And exactly what components they need to complete those builds.
Precisely.
We need to explain exactly what is driving this demand.
Because it is a very specific type of hardware.
Right. When you hear AI chips, it is easy to default to thinking about just a single type of processor.
General computing.
Yeah, but Marvell operates in a highly specialized arena. We are talking about custom AI chips, optical connectivity, and data center interconnect products.
The distinction there is critical.
They are essentially building the nervous system of the modern data center.
That is a great way to put it. Everyone knows about the graphics processing units, or GPUs, handling the raw computation.
Right.
But Marvell is operating in the connective tissue. They are designing application-specific integrated circuits.
Custom chips built for one exact task.
Rather than general computing. And they are also engineering the optical connectivity components and the data center interconnect products.
Which physically move the data.
Between the AI processors, the memory banks, and the various servers housed within a facility.
I want to use an analogy for you, the listener, to visualize this because the mechanical function dictates the market value.
Go for it.
Think of a massive AI cluster as a sprawling industrial city.
Okay, an industrial city.
Nvidia is building the state-of-the-art factories. Those are the GPUs doing the heavy lifting, crunching the numbers, and manufacturing the AI models.
Calmly contrasting that with Nvidia's leadership, yes.
Exactly. But a processing factory is completely useless if you cannot get raw materials in or finished products out quickly.
You need roads.
Exactly.
Yeah.
Data center interconnect products are the multi-lane highways, the high-speed rail lines, and the traffic control systems of that industrial city.
They dictate how fast the data can travel from the memory warehouse to the processing factory.
And that highway infrastructure becomes the ultimate bottleneck as the city expands.
Because as these AI clusters scale up, meaning they are adding tens of thousands of new GPUs for larger workloads,
the sheer volume of data trying to move between those processors creates a massive traffic jam.
you can have the fastest processing factories in the world.
But if they are relying on a two-lane dirt road to share data...
The entire system slows down to the speed of that dirt road.
Right. So Marvell provides the high-speed transit systems that allow the entire cluster to scale efficiently.
Nvidia owns the processing, but Marvell provides the essential plumbing required for those processors to talk to each other at scale.
Which brings us to our first ticker callout, Marvell Technology, trading under the symbol MRVL.
Their dominant position in this high-speed highway construction is exactly why the market reacted to their multi-year outlook.
It proves the physical infrastructure build is continuing at an aggressive pace.
That reality is what allows us to segment the broader market into very clear winners and losers based on this single data point.
Because the stock market is a mechanism for allocating capital.
And when it receives a clear signal about where corporate money is actually being spent, capital rotates accordingly.
Looking at who benefits directly alongside Marvell, we find our Category 1 winners.
The AI custom chip and interconnect leaders.
These are the companies directly tied to the AI buildout through networking, high-speed interconnects, and custom chips.
Marvell's forecast proves hyperscalers are spending heavily on AI infrastructure.
The primary names in this category are Marvell Technology, MRVL, and Broadcom, AVGO.
What ties Marvell and Broadcom together is their absolute dominance in networking protocols and custom silicon.
As we discussed with the highway analogy.
Yes, as hyperscalers build larger data centers, the proportion of their budget spent on networking increases.
Broadcom and Marvell are the primary suppliers of the specialized switching chips and custom hardware that route data at massive speeds.
They have engineered the highly specific solutions required to keep these clusters running without latency.
And the custom silicon aspect is crucial here.
It really is.
If a tech giant decides that they want a chip designed exclusively for their proprietary search algorithm or internal AI model, they do not buy an off-the-shelf product.
No, they go directly to companies like Broadcom or Marvell to design that custom piece of hardware from the ground up.
To maximize power efficiency and workload speed.
Because they are providing the engineering services and the underlying intellectual property.
They help cloud providers build their own specialized hardware,
which reduces the cloud provider's reliance on standard processors over time.
And optimizes their specific workloads to an extreme degree.
So Marvell's $15 billion projection for fiscal 2028 is a direct numerical indicator that this trend of custom hardware is accelerating.
Placing both Marvell and Broadcom in an exceptionally strong market position.
Absolutely.
Knowing that custom silicon and networking gear are in high demand naturally leads us to winners category 2.
The hyperscale cloud buyers and AI infrastructure spenders.
These are the companies actually writing the checks for all these highways and custom factories.
The ones funding the build-out.
We are talking about Microsoft, MSFT, Amazon, AMZN, Meta Platforms, META, and Alphabet, GOGL.
This represents the funding side of the capital expenditure cycle.
The ongoing debate in the market revolves around how long these hyperscalers can sustain this massive level of spending.
On physical assets like data centers, servers, and networking gear.
Wall Street closely monitors the capex trajectory of these 4 specific companies.
Because their spending dictates the revenue of the entire hardware supply chain.
Marvell's outlook is the ultimate confirmation that these capex cycles are nowhere near slowing down.
Strong demand at Marvell proves these cloud giants are still deploying AI at scale.
Microsoft, Amazon, Meta, and Alphabet are the entities with the balance sheets large enough to support a $15 billion revenue line for a single infrastructure supplier.
It acts as a definitive proof of purchase.
You do not tell the public market you are making $15 billion in 2028 unless Microsoft, Amazon, Meta, or Alphabet have given you extremely clear indications of what they plan to buy.
Over the next few years, exactly. It removes a layer of uncertainty for investors who monitor the hyperscalers.
If the infrastructure suppliers are forecasting high growth, the hyperscalers are clearly seeing enough internal demand for their AI services.
That they must continue aggressively building out their future capacity.
And because the hyperscalers are writing these massive checks, that capital naturally spills over into the physical gear that connects everything.
Right.
Which brings our winners category 3 into the spotlight. The AI optical and data center connectivity ecosystem.
You have the custom chips, you have the hyperscalers buying them, and now you need the physical links.
The companies here are Arista Networks, ANET, Ciena, CIEN, and Coherent, COHR.
This category operates heavily on the mechanics of a sympathy trade.
Explain that for the listener.
When positive news confirms expansive demand for one segment of data center architecture, the market immediately bids up the valuation of other companies providing the necessary complementary hardware.
As AI clusters grow, the demand rises strictly for optical links, networking gear, and high-bandwidth connectivity to manage the traffic growth inside the facility.
Right.
Let's break down the physical reality of optical connectivity.
This is a great point.
At the speeds required by modern AI training models, electrical signals sent over standard copper wire face severe physical limitations.
Copper generates too much heat.
And the signal degrades rapidly over anything longer than a few meters.
AI clusters require moving terabytes of data across a massive warehouse in fractions of a second.
Which demands optical transceivers.
Using light to move data becomes the absolute baseline requirement.
Optical transceivers convert electrical data into light, shoot it across a fiber optic cable, and convert it back to electrical data at the destination.
Without the heat or degradation issues of copper.
Ciena and Coherent manufacture these critical optical components.
While Arista Networks provides the heavy-duty networking switches that direct that traffic.
Naturally, when Marvell outlines a multi-year growth trajectory for data center interconnects, the market looks at Arista Networks, Ciena, and Coherent.
And prices in a corresponding order book expansion for them as well.
They all serve the exact same end market expansion.
The AI traffic growth necessitates high bandwidth connectivity, and these companies provide the physical gear required to execute the architecture.
Every dollar that flows into these AI winners has to come from somewhere, though.
Capital is finite.
And when institutional portfolio managers aggressively rotate toward one sector, it drains liquidity from another.
Which brings us to the relative losers in the current environment.
Let's examine losers category 1, traditional chip names with weaker direct AI leverage.
We are talking about Texas Instruments, TXN, On-N Semiconductor, ON, and Microchip Technology, MCHP.
To be clear, we are not talking about failing businesses.
No, not at all.
We are talking strictly about relative performance and opportunity cost in the current market environment based on where the capital is flowing most aggressively.
That is an essential distinction. Texas Instruments, On Semiconductor, and Microchip Technology operate heavily in analog chips and microcontrollers.
Their primary end markets are automotive manufacturing, industrial automation, and consumer electronics.
And right now, the automotive and industrial sectors are experiencing standard inventory corrections and cyclical slowness.
If you are building an electric vehicle or outfitting a factory assembly line, you absolutely need products from TXN or ON.
But they are not the ones engineering the multi-lane optical highways for a Microsoft data center.
Right.
Because institutional investors are comparing a cyclical industrial slowdown against the greater than 30% growth projected by AI infrastructure names like Marvell.
Capital mechanically rotates away from the slower traditional chip names.
The lack of direct AI leverage makes them relative underperformers in this specific news cycle.
That exact rotation logic applies perfectly to our losers category too.
Legacy enterprise hardware and slower growth server exposure.
The companies mentioned here are Hewlett-Packard Enterprise, HPE, and Dell Technologies, DELL.
If the market continues rewarding specialized AI infrastructure over traditional enterprise compute, these legacy hardware names will face headwinds.
Unless they show much stronger AI demand.
We must carefully differentiate between a hyperscale cloud facility and a standard corporate IT closet.
A traditional non-tech company, whether it is a regional bank, a retail chain, or a hospital network, needs servers to run their daily operations.
Their payroll and their internal software.
Historically, they buy standard server racks from HPE or DELL.
That is the foundation of traditional enterprise hardware.
But corporate IT budgets are generally a fixed zero-sum game.
If a chief information officer decides they need to allocate a larger portion of their annual budget to cloud-based AI software or AI services,
that money must come from somewhere else in the budget.
Often, the easiest way to find that capital is by delaying the upgrade cycle of their on-premise legacy servers.
They make the deliberate choice to keep their old Dell servers running for an extra 2 years.
So they can spend that budget on AI tools instead.
While Dell and HPE are absolutely working to build AI-specific servers to capture some of this new spending, their core legacy businesses face immediate headwinds from this dynamic.
When a headline highlights a $15 billion future for high-speed AI connectivity, it reinforces the narrative that the bulk of technology spending is aggressively moving toward the cloud.
And away from the traditional on-premise enterprise compute models.
Exactly.
We have to look at the other side of the processor market as well.
Which brings us to losers category 3.
Chip makers competing for AI budgets without the same interconnect exposure.
We are talking about advanced micro devices, AMD, and Intel INTC.
They make incredible general-purpose processors, but if the bottleneck is the highway and not the factory, they're suddenly competing for a shrinking slice of the budget.
This dynamic highlights a very specific evolution in the AI trade.
Initially, the entire focus was strictly on the processor.
Who could build a chip to rival Nvidia's GPU?
Both AMD and Intel have spent heavily on research and development to compete in that specific arena.
But Marvell's update reinforces that the AI trade is expanding strictly beyond processors and moving rapidly into custom silicon and connectivity.
Intel and AMD are primarily known for general-purpose computing.
They are geared toward high-volume production of standard CPUs and GPUs.
However, they do not possess the same dominance in the specialized networking, optical interconnects, and custom ASIC designs that Marvell and Broadcom has spent years perfecting.
If a cloud giant is spending a massive percentage of their budget on custom highways and optical bridges designed in partnership with Marvell,
That leaves relatively less budget to experiment with alternative general-purpose processors from Intel or AMD.
it suggests the hyperscalers are actively choosing to optimize their infrastructure specifically for their own needs.
Rather than buying off-the-shelf alternatives.
This dynamic forces Intel and AMD to prove they can capture market share in an environment that heavily values specialized proprietary networking just as highly as raw computing muscle.
Let's pull all of this together for the trading takeaway.
We have analyzed the direct numbers, examined the underlying hardware mechanics, and traced the specific capital flows.
Summarizing the core message cleanly for you, AI infrastructure demand looks exceptionally strong.
The initial reaction to Marvell's outlook heavily favors custom silicon, networking, and optical connectivity.
The weaker side of the trade currently sits with the broader chip and hardware space, those companies lacking direct AI cluster expansion exposure.
Companies dealing in legacy servers or focusing solely on traditional analog and automotive markets.
The reported data dictates the capital allocation.
As long as the hyperscalers are funding the physical build-out of these massive data centers, the infrastructure providers who supply the connectivity and custom engineering will see the most immediate and pronounced benefit.
We want to leave you with a final question to ponder based purely on the facts discussed today. Something to think about.
If capital continues to rotate this heavily into high-speed interconnects and custom AI infrastructure, what happens to the baseline innovation and funding for traditional enterprise hardware and legacy systems over the next 5 years?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for your time today. We appreciate you joining us for breaking news to trading moves. Goodbye.